Now, our first guest today says now is the time to bet against the market, and he is shorting equities, currencies, as well as commodities. He is Stephen Hammers, a portfolio manager for the Compass EMP Alternative Strategies Fund. This fund is designed to provide positive returns in both up and down markets by investing in alternative asset classes and also hedging downside risk. Stephen joins us now from Nashville, Tennessee. Stephen, good to have you join us. We know that you invest across asset classes, and as we mentioned, you're short an awful lot. 6 of the most liquid currencies, you're shorting 15 of the most liquid commodities, and you're shorting all 12 of the most liquid equity markets. So suffice it to say you're pretty bearish right now.
There's no doubt. There's a tremendous amount of uncertainty in the market. Prior to June of 2011 and even the last 2010 and 2009, we were long because of the upward trending of the market. But there's too many problems, tremendous amount of problems in Europe with debt, the economy, tremendous amount of volatility right now.
So which securities are you long on, and how do you take those positions?
Well, we're not long any of the stock markets in the world. They're all short because if you look at many of the prices since April, most of the markets around the world are down. The S&P happens to be the top performing asset class in terms of U.S. equities, still in the negative territory, but the most promising asset class right now is obviously U.S. Treasuries.
Even with yields where they are right now, within 25 basis points of a record low for the 10-year?
That's exactly right. Europe has a tremendous amount of debt issues and problems. We're most likely going to see a declining euro over the next year or two, possibly to about a 115 range compared to the U.S. dollar. It's very, very dangerous territory, and it has a lot to do with the Eurozone.
We continue now our focus on the Compass EMP Alternative Strategies Fund with portfolio manager Stephen Hammers. And Stephen, you call your fund a hedge fund in a mutual fund. Can you explain what that means?
Well, traditional mutual funds have U.S. stocks, international stocks, bonds that actually only have the ability to profit when markets go up. When markets go down, many investors suffer, especially like what we went through in 2001 and 2 and 2008. We have the ability to force low correlation when we need it and force markets to either reduce volatility tremendously or actually go in an upward direction while markets are declining.
You just mentioned 2 buzzwords of this year, volatility and correlation. How has the record volatility that we've seen and the correlation that approaches what feels like one oftentimes made your job more difficult since this fund was launched back in early 2010?
It is a tremendous amount of volatility this year. We've been managing money this way for institutions for a long time. Volatility for the S&P 500, for example, is historically about a 16% standard deviation. Right now, it's about 32% standard deviation, and we've had the ability on the Alternative Strategies Fund to have 70% less volatility than the U.S. stock market, and other funds, we've even had lower volatility than that. So we've been able to cut that down. When markets were increasing, our correlation to the markets were in the 80% range. Now it's actually negative 80%. And so when investors are looking for diversification beyond stocks for growth, they need to be looking at alternative type assets to help reduce their overall volatility.
And you invest in other asset classes through futures as well as exchange traded funds, is that right?
That's right. Futures gives us a tremendous opportunity to go long and short, which is what enables us to create that lower volatility. Exchange-traded funds allows us to get access to certain markets like the real estate market, for example, which is the only ETF exposure we have in this fund. The rest are through futures markets, which provide us a tremendous amount of liquidity, whether it's the global bonds, global currencies, commodities, stock markets around the world.
You mentioned real estate. We got some data this morning that showed existing home sales actually were about 14% lower than we had previously expected because they had to revisit the way they calculated the numbers. So it looks like housing is in a bigger slump than previously expected. Does this really change your view in any way? Is it a game changer?
It's not a game changer. Because of the amount of uncertainty, because banks have a very difficult time lending, and because of the problems that we went through with the real estate market being so tremendously high, we should have had the real estate market correction back in 2004, 2005 instead of '07. And so it's going to take a long time, and real estate is one of the key factors that's going to have to bring us out of this slow growth period, and it's just, I don't think that's going to happen anytime soon.
Yeah, real estate is certainly one of the weak links of the economy overall. You talked about the correlation and how it's increased. Where do you see the least amount of correlation right now?
Well, the least amount of correlation, it depends on how an investor invests their money. If they have a long-only exposure, it's going to be with Treasuries. If they have a hedging or a long-short exposure, then the only way you can get low correlation to the stock markets around the world is to have the ability to short when markets go down. And so there will be months where you'll have negative correlating to stocks, like in October. We went down in October, but we went up in November when the stock market declined. And so that's what gives us the ability to have lower volatility. But when you add alternative investments to a traditional stock and bond portfolio, it's amazing what that can do to the overall volatility for the average investor.
What's the most crowded trade out there right now? I know that you talked about being long on Treasuries. That certainly sounds like it could be a very crowded trade.
It is. A lot of people are flooding to safety. Especially this summer, investors were flooding to the U.S. dollar. We were actually short the U.S. dollar the previous 2 years prior to this August and September of 2011. But when everybody floods to safety, unfortunately what that does is it drives yields down and drives prices up. And it's very difficult for the 10-year Treasury to stay in the range where it is. It's most likely going to go down even further in 2012. Possibly at about 1.5% range, but and then most likely in 13 and 14, we're going to see some rising interest rates.
Okay, and you talk about people heading to safety. We've really seen that with gold, except for the last couple of days, last week or so. It's falling below its long-term trend line, and 1618 is now resistance. But you say gold will continue to push higher.
Well, we're staying in a volatility range right now. It is slightly down. It's still positive for the year. But going into 2012 and 13, we have to remember that we still have a debt crisis. We have to remember that, unfortunately, the U.S. policymakers are still spending far more than what they make. And the same with Europe. And the gold levels that we have today are not sustainable. They have to increase if you really look at the fundamentals and what causes gold to go up. And so even though we most likely will see commodities declining next year based on the world economy, gold will most likely go up quite significantly over the next few years. And it has everything to do with the amount of spending that is out of control around the world.
All right, we thank you for your time and your perspective. Stephen Hammers, Compass EMP Alternative Strategies Fund Portfolio Manager.